Before we actually dive into the modeling, let's just understand where M&A is today. So global M&A is at the highest level that it's been since 2007. The first half of 2014, M&A is up 50% from the first half of 2013. In terms of premiums, because the stock market is doing so well, it means that if you want to buy out a company, you're going to have to pay higher and higher multiples to make it happen. And so premiums have increased. 42% of deals have premiums between 25 to 50% in the first half of 2014. Again, it reflects that the overall equity market is strong. And you can see that EBITDA multiples, for example, which are sort of a good benchmark, are reaching the 11 times mark. And that represents a fairly high multiple by historic standards. In fact, let's take a look at a clip of the head of Citi's M&A group talking about this improvement in the environment.
And this is as good as it's been since the financial crisis, the 07 period. I don't think I expected it to ramp this quickly. And obviously the transformational end is really driving the deal flow. But for example, we had our second largest week in volume ever in the firm's history 3 weeks ago. So it's big, it seems to be sustainable. I do have some concerns around pricing, but beyond that, we're in a real upcycle.
Yeah, I mean, it's driven by strategics. We don't typically talk very often about private equity guys, which back in 06, of course, were one of the key drivers of what was then record numbers in M&A.
Absolutely. This is it's about strategic deals. It's obviously there are other things going on with inversions, but quite clearly it's the high end of the market that's really driving this, and we don't see anything that's going to stop it at this juncture. The macro economy is a little better. The desire for growth from the investor base, and very benign capital markets. I mean, all these things sort of fit together, and it's created quite a cocktail mix.
Well, you say you don't see anything that's going to stop it, but at your first answer, you did mention valuations.
I did mention valuation.
And I'm looking here at a slide that you guys sent my way. That gets me a little scared when I look at the multiple to EBITDA, which I talk about often, approaching 12. And I go back, when was the last time we were at this level?
2007.
There it is.
No, if you look at the chart, I mean, what's interesting is in the third and fourth quarters of last year, as the volume really began to ramp, we started to see pricing come up. So if I step back from this, the concern that I've got is, in previous cycles, when you hit peak pricing sort of towards the end of the cycle, what makes me a little nervous at this point, partially driven by healthcare and some of the valuations we're seeing, is could this shorten the upcycle if pricing gets to the point where buyers just start to revolt or react?
Well, should I be worried as an investor that perhaps these strategics are getting a little bit too much animal spirits and overpaying?
Look, at this point, it's very difficult to say. Most of the deals we see are strategically driven. They do appear to be financially accretive, cash flow accretive. Questions about ROIC is another, because some of the deals on an ROIC basis are harder to justify. But on balance, I think it's too early to call it, but I do think it does give me some pause for concern.
Now let's flesh out some of those trends that he talked about in a little bit more detail. The U.S. makes up 50% of all global M&A volume and nearly 40% just by deal count. Several large investment banks, which we call bulge bracket firms, account for a large portion of M&A deal volume. You see Goldman, Morgan Stanley, Bank of America, JP Morgan, Citi sort of represents the usual suspects for the top 5 firms, and Barclays sort of hangs around there, as well as some of the firms that you see on this list. And you see them sort of trading off in the league tables across different regions. In terms of the industries that represent a bulk of M&A, consumer non-cyclicals and financial services firms represent almost 50% of all deal activity, and a lot of that is often skewed by major deals. You see other industries represented as well in this pie chart. I've included the full breakdown, both from a merger market report on the state of M&A in 2014, as well as a Bloomberg report on the state of M&A 2014, which lets you sort of delve into this in a little bit more detail. If you're watching this and it's 2015 and this data is a little bit stale, if you go online and do a little bit of Googling, you'll find merger market quarterly reports and Bloomberg quarterly and semi-annual reports available sort of freely online. Here you see a deal size breakdown. You see what's interesting is that the vast majority, and this is always the case, the vast majority of deals, 97% of deals by number, are actually small mid-market deals, whereas the actual majority by dollar volume are sort of concentrated, as you might expect, with sort of these mega deals that represent the majority of deal volume, but only sort of 2% of only 2 or 3% of the actual number of deals. Let's also talk about a dynamic in the M&A industry that's been an important dynamic for a long time now, and that's the idea of private equity buyers representing a large part of M&A activity. So both strategic buyers, these are non-private equity firm, non-investment firms buying companies for strategic purposes. Both those types of buyers and private equity buyers are involved in M&A. Perhaps some of the big differences from the perspective of the seller and the buyer themselves is the PE deals don't get the benefit of synergies. There are no real synergies in a PE deal because you don't have overlapping workforces and infrastructure that you can shed. But the advantage of PE transactions is that private equity tends to have greater efficiency and focus, and has a focus on exit strategies. It's typically 3 to 5 years out, as opposed to a strategic acquisition that may just sort of buy a company and hold it indefinitely, or try to integrate it into the parent. So since 2007, private equity has been accounting for a growing share of M&A volume. In fact, it represented a growing part of the M&A volume leading up to the crisis as well. 25% of all M&A volume in 2013 was from PE buyers. Now, that has actually shifted quite a bit over the last year, whereas in 2014, the private equity share of M&A declined pretty significantly to 17%, as strategics have made what is sort of being considered somewhat of a comeback. Strategics were on the sidelines post the financial crisis for a long time, generally concerned about getting back into the M&A activity. But it appears as if, at least in 2014, there's been somewhat of a comeback. Acquirers are now doing more deals. The equity markets that have been pretty strong have made IPOs relatively more attractive, and so PE as a total share of overall M&A activity has declined a little bit. And strategics and other opportunities for sellers like the IPOs mean that the PE part of it is a little bit less than maybe it was last year. Okay, I'm going to leave you with another CNBC clip, this one from 2.5 years ago, the beginning of 2012. Same Mark Schaefer, head of Citi M&A, same Faber report. You'll see what a difference 2.5 years makes.
Welcome back. We're coming off the slowest first quarter for deal making since 2004, with just about $580 billion in announced global M&A in the first 3 months of this year. Our next guest says while the necessary conditions for a healthy merger and acquisition market are in place, the question is still all about confidence. Mark Schaefer is co-head of global mergers and acquisitions at Citigroup. He also heads up that technology, media, and telecommunications banking group. Always nice to have you back.
Thanks,
on
David.
CNBC.
It's good to be here.
All right, I could have said the same thing 3 or 4 months ago. A lot of those key things are in place, but we don't see the deals. Why not?
Look, it's just, we're frustrated and disappointed. I think a lot of us felt with an improving macroeconomic set of conditions, with good corporate liquidity, good margins, good earnings, it felt like we were in a better position.
And a pretty good stock market, by the way.
The fact is it hasn't happened.
Yeah, usually when you have a stock market the way we did in the first quarter,
right,
CEO confidence starts to gain real traction. What's going on? What are your conversations like? What is it that the executives seem to be worried about, at least at this point, in terms of starting the conversation, perhaps even pulling the trigger?
Look, I still think there's, some degree of what I'd call, sort of risk aversion out there at this point. There's still pretty good dialogue, but we're lacking the big deals, and that really goes to the confidence issue. So we don't see it. We got a lot, as I say, a lot of the good conditions are here. A lot of us have expected a better first quarter. Some of us still expect a better second half.
Do you expect a better second half?
I think it'll be marginal at this point. I think
that's changed a bit, hasn't it? You were a little more positive, as were many bankers.
Much more bullish just a couple of months ago. It is definitely dampened. The enthusiasm's dampened. On the other hand, financing conditions, there are a lot of great things. There's money's available. We're in a pretty good spot, but you got to have buyers and sellers transacting. We don't have it. Yeah,
well, I guess so. It gets back to what CEOs see in their businesses or concern about their businesses.
Yeah, I think clearly it's that. Whether it's a higher degree of political risk, both in the developed nations and some of the emerging nations. We saw Repsol, YPF today.
Right.
Whether it's just a sense that better to focus on organic growth and build one's business. At this point, we're seeing some smaller stuff, what I'd call middle of the fairway, but the real bet the company or very material type transactions.
The transformational kinds of deal that you're describing is the one that typically brings another deal and another and another, doesn't it?
It's sort of the knock-on effect in an industry or sub-industry. As I say, I think, again, there's some stuff out there. There's still dialogue, but it's been disappointing relative to what many of us expected.
All right, but in terms of what we can expect at least, and this year may shape up to be a poor one unexpectedly, where should investors at least be focused? Where's the activity? I know industrial deals have accounted for a lot of the volume, kind of unexpected.
I mean, look, Glencore was a big portion of the industrial volumes in the first quarter. I think that energy's been very, very hot. We see real estate's been surprisingly a pretty big percentage. Financial institutions always pretty good. Technology, I think that, there's some interesting stuff in the tech world that we see. So there's still
Instagram.
Pretty good.
I mean, there wasn't even a public company. It was an amazing deal.
It just goes to show the power of in that space, short product life cycles, and the need for something, and just how fast companies can gain in value. But I still think there's still pretty good rationale for it. A lot of the basic things we tend to see. Cross-border business is down, but interestingly enough, out of Asia, that's been the big in terms of number of deals. It's been driven by Asia. Japan's been big. So there are some pockets of, I'd sort of say brightness in an otherwise sort of fairly bleak
and the LBO
business. Guys
have been somewhat quiet, it would seem, at least given how much financing may be available, not to mention how much equity they've raised in their funds. I'm sure they want to put it to work, but again, a lack of deals given that environment.
I don't think it's a lack of desire. I mean, we are seeing, we see the El Paso transaction get done in the energy space. But again, you got to get seller. You need sell-side inventory, and we don't have that much of it at this point. But again, a lot of the ingredients for a decent transaction environment are here. We just feel like we're all dressed up, waiting to go to the ball, but there's no ball.
Oh, and what about TMT, which you have a real focus on yet again in your career? I mean, we see the likes of a number of distressed players, so to speak, a RIM or a Nokia. Is it possible that those presage potential deals, not from strength but from weakness?
Tough to say. I mean, what you always look at is there enough there, and at what value? In terms of what's left in the technology, the quality of the companies, and the like. I think surely there could be some of that. But I think the big issues that we tend to focus on, social networking, sort of big data, kind of next-gen mobility, those are the sorts of things. The cloud are really the big drivers, I would argue, at this point. And whether the legacy guys, some of the legacy technology, some of the older line companies fit in, is an interesting question.
All right, Mark, as always, appreciate your insights, even though they weren't as upbeat as we might have hoped.
We're trying.
Yeah, keep trying. Mark Schaefer, co-head Global M&A at Citigroup.